Now, the New York lunch macro is just a retracement inside of the entire daily range up to, on a down day, the low and to the high. Okay, so because it's been exceedingly weak this morning, the market is more likely to go back into that range and seek what? Buy side. Now, here's the wonderful thing about that. Even if this were to continuously go higher and not go and roll over to go lower in the afternoon, you're still likely to get something, some kind of meat on the bone for a trade idea. But it requires certain things. Okay, so I'm going to walk you through it, a little bit more detail than I gave in the previous video, and how this ties into how we can engage in the afternoon session or PM session, and then use that information to really shine the light on what price action may do in the last hour or regular trading hours. So at 10 o'clock, this is what you're doing for the lunch macro. Okay, these are the rules for it. Okay, it's very simple. I was going to put this in a book and be its own little chapter, but I'm going to teach it to you here. Okay, I know it's going to end up in everybody's mentorship. Just make sure that you copy me exactly what I'm saying here. Don't copy my video. Don't take my video and change it into your language. Do the work of making your own chart and then repeat verbatim. That way, when the people listen to you and you don't mention my name because you don't want anybody to know that I'm teaching this stuff for free, at least they'll know how to do it correctly. Okay, so when a market move takes place in the day at the opening bell here, and we trade all the way down one directional, and there's no run on any minor buy side liquidity pool. Notice that no short-term high was taken in any of this drop. When that occurs, you're setting yourself up to see a retracement going back into that range. Now, how far of a retracement? What is the rules for my New York lunch macro? Your time filter is 10 a.m. So at 10 o'clock in the morning, put a vertical line on that. And I just put a line segment so that way it's nice and easy to see everything, every individual candlesticks high and low. From that point there, walk forward in time, going to the right. As soon as you start here, go all the way up through all this price action and then start working your way to the right. What's the first high you come to? This one. See how easy that is? That is not complicated. And it's also not in any of your other books. Nobody else talked about this. I'm giving you this because it's a dandy of an idea, because it's rule-based, just like my silver bullet is. There are certain criteria, certain conditions where these one-trick pony type setups that I have simply work wonderful. And in trading, if there is an algorithm, and I know some of you don't believe there is, if there is an algorithm, it would refer to things like this. Very specific time elements first, and then price elements. And when you blend those two together to get a narrative, we saw price create a short-term low here. I don't need to be long from that. I don't need to be short to capture that low. What I'm waiting for is I want to see the market trade back up into a premium array. It does so here. Trades lower, comes back down, and in this swing low, I want to see, does it fail to break that low? Real important, okay? Because it could have taken that low out, okay, then I would have to use a different strategy or do nothing and trade in the afternoon only. But because it does not take out that low on this pass down lower, then I'm likely to see what? A return back into that first high that formed after 10 o'clock. So that's why I'm picking that specific high. For the dozens of you that left the comment in the video saying, why did I pick that high? Now you know. Isn't it easy? It's very easy. The rules won't change. Now, for those that are contemplating on how this would be done if it was a day where it was going up precipitously in the beginning, you would simply use the 10 o'clock hour. At 10 o'clock, move to the right, and the first swing low you come to, that's the low that the New York lunch macro will reprice to. Or at least that's the one I'm going to aim for, okay? Very, very, very simple strategy. No one's ever talked about it. You'll never find it in another book, but I promise you in 30 days or less, Someone's going to be sitting down and writing a little pamphlet for Amazon so they can sell this idea like it was theirs. And I'll hear about it, and then I'll go into your little reviews and I'll say, this was taught for free on Inner Circle Traders YouTube video in this channel, like I've done with other people that wrote books. And you look silly then, okay? So people won't be buying your book there either. So the idea of at 10 o'clock hour, it closes the opening range. Okay, that's why 10 o'clock is significant. So we had the opening range behind us. So because of that being the case, the algorithm now has a frame of reference. What PD arrays exist in that 30 minutes of trading from 9:30 a.m. Eastern time to 10 o'clock Eastern time? What's the first presented fair value gap? What is the liquidity that's offered in there in terms of minor and sell side and minor buy side? Well, since we dropped, it's reasonable to anticipate the market likely retracing, but to where? We don't need VWAP. We don't need all those other things. They're gimmicks. The algorithm has absolutely no respect for a VWAP. Zero. None. Period. So if I see this low in here, as it's approaching it here, I want to see it fail to take that low. At a time when price should be showing what? Spooling, where it's starting to run for liquidity. So let's zoom in a little bit here. Here's that 10 o'clock hour again. That's our time filter. So we go to the right at that time and we find the first high. Whatever the highest high that forms immediately after 10 o'clock, that's the one we're aiming for. That's the lunch macro. That's exactly the low-hanging fruit objective for the lunch macro. Now, in the recording this morning, before the fact, I had already used this one, but I also said that this one here would be potentially another scenario where it could trade up into that. Now, you're looking at that and you're thinking, wow, he forgot to use the inversion fair value gap high and the inversion fair value gap low. Yes, I did. But between these two candlesticks wicks, that's enough to zero in on another area of potential upside after it takes this high out right there. This gap here becomes an inversion fair value gap. And you see me do this actually in the recording. So I'm annotating all these things. Now, for the guy that left a comment saying that I was full of crap, that I recorded the video and spoke over, I actually did speak over the video, but you can't take away all of the things I was annotating and where my stop loss was the entire trade. I'm just giving you the details because I've had a lot of things going on in the house today that kept me from being as engaged as I normally would be. So I understand that there's men out there that just simply can't do this themselves and they're hateful. But your comments get deleted. I never see you again. But just pay attention because I'm trying to teach you still. That swing low after 10 o'clock. When the market comes down, I use that closing price. It's a rejection block. Look at month 4 of the 2016 ICT mentorship playlist. It's on my YouTube channel. That is my paid mentorship. You can go there and study what a rejection block is. It's its own video, and they're not very long. So that is a rejection block. The market's going to trade down through that, and then I want to see, does it in fact reject there? Well, here we have it. It's going higher. And then we have this buy side imbalance, sell side inefficiency. And as we trade higher above this short-term high, we have a market structure shift that's bullish. So now we have scenarios overlaying and overlapping one another, converging with the idea that this could potentially be reversing intraday. And I don't care at this time if it's going to take out the relative equal lows. I don't care about that yet. I want to see after we take that short-term high out, we do so here. I don't need it on a closing basis. Go back and listen to what I taught in 2022, 2024. Market structure shifts do not require a close above or close below. Stop listening to people that did not take good notes when watching my videos. Then we have an immediate rebalance. Okay, immediate rebalance is this candlestick's high, which essentially is the low of this buy side imbalance, sell side inefficiency that's shaded in blue. And the next candle opens here, trades down. I'm buying in that. Watch the recording. It's already on the YouTube channel. It's a video right for this one. But because it's touching these two candlesticks price points, the high here and the low of that candle, and it's converging with the low of the buy side imbalance, sell side inefficiency, that makes it an extremely likely scenario that it's going to go higher. And it does so. It repels from there and then continues its market structure shift to the upside, goes into this inefficiency here, retraces a little bit into this gap, and then rallies up, inversion fair value gap, bullish fair value gap, trades to the target I aimed for, and the logic that gets to a lunch hour in New York macro. The macro, all macros are little scripts in the algorithm. Okay, they're little tiny lists of directives and instructions. Start doing this and do this to this degree, to this direction by this much time. Okay, so I'm not going to teach you all the facets to that, but I'm pointing you at the time of the day and where these functions usually come in and create these opportunities. Over time, you're going to start seeing these repeating phenomenon, and you'll be convinced that there's an algorithm. But initially, it just seems like cherry-picked trades. And I get it. I understand that. But when you practice it yourself and start backtesting, you will see more fruits and evidence to these things being the very things I'm telling you they are. And eventually, after we trade into this buy side imbalance, sell side inefficiency, it rallies again, create another higher high. And then we have a order block, which is when we have a wick above the candlestick and then the open. We want to use that frame of reference. Okay, so it's not always just the opening price. That's the change in state of delivery. It is the high of the wick. When do you use the wicks? When do you use the opening price? Again, because the wicks are there, you have to use that information. And that's shown to you here in the dashed line. It comes down, bullish, run up, comes back down, finds the high of this buy side imbalance, sell side inefficiency. Note the volume imbalances. The market stops dead in its tracks with its bodies. Wonderful delivery there. Into the upper objective I gave you during the recording this morning. At the time of that recording and when I was talking over top of it, it only took a couple minutes for it to be processed and sent to the YouTube channel. It had not done this yet. Okay. So what I wanted to see is in the afternoon, do we fail to go through this on the upside? Now, all of these PD arrays, let's watch what this happens here. All these PD arrays that are in blue, okay, they're going to change their characteristic where they are used as a bullish discount array here because this is a pseudo market maker sell model. I'm going to be aiming for these relative equal lows if this fails to see price go above it by 1:30 Eastern Time, New York. Okay. And then I want to use all the things that were pertinent to all the buy side of the curve when the market's been going up. And again, this is not Wyckoff. Okay. Go back and look at your Wyckoff text. You will not see this stuff, folks. It's just not simply there. It's not going to be there. All of these details here are very specific price points. Very, very specific price points. The consequent encroachment level, the high, the low, and the quadrant levels. And when we're bearish, we want to see the upper half of these PD arrays not respected, just completely disregarded. Or in other words, when they leave the upper half of them, it should never come back to them and just start working in the lower half, proving heaviness in price. Price will likely draw down into these lows here. Okay, so the low comes in at 21,436.25. That's the low here. Okay, so all these candlesticks and ranges and such that I've outlined here, they're going to change their characteristic from that of being bullish here. Now they're going to be inversion levels. And we're going to carry these levels all the way into the future, into the afternoon, like we have here. So we have at 1:30 to 2 o'clock in the afternoon time, Eastern time. That's your opening range for the PM session. Same thing I taught you to do in the morning session between 9:30 and 10 o'clock in the morning, Eastern time. This is your opening range. Where's your first presented fair value gap? Right there. Oh, and if we're looking for the relative equal lows to be taken out and trade down to 21,436.25, this level here, then it's likely to do what? Use that inversion fair value gap as a premium array. So you want to see it trade away from it, proving itself, and then come back up, hits it here. Well, there you go. It's also the low of that inefficiency I gave you in the morning. Market breaks down, trades back up, falls short of that range again, starts to drop again. That's what you want to see. That's heaviness, it's weakness. It can't even trade back to the low, that blue shaded area. Breaks after 2 o'clock. Now we're in the heat of PM session trading. Trades down, and now look at the characteristics of price action responding to all of the very specific price levels that were used as bullish arrays in the morning session. Now we're on the sell side of the curve. Okay, so the market maker sell model is going to use all these reference points, and it's not going to use the upper half. It's going to go down, trade through, look at the body staying inside this inversion, breaks lower, comes back up, respects what? The lower half, and disregards the upper half. That's exactly what you want to see the algorithm signaling to you. They are signatures of algorithmic price delivery. I'm sorry to hurt your feelings, but Wyckoff knew nothing about an algorithm. It absolutely did not get implemented at all in these coding. There's no Wyckoff in the algorithm. Zero. Absolutely none. No Elliott wave, no supply and demand zones, none of this stuff that you think is out there as an excuse for you to say, I'm teaching smart money concepts and it was around by this old guy. No, I'm sorry. I'm sorry. That's not true. So we're seeing all the effects of these discount arrays now inverting themselves and their characteristics to repel price going lower. So these are all the things, these are the things I'm writing in my notepad. All of you always ask me, what am I writing down? What's on your notepad? It's these levels here. Whenever I'm seeing price action use these very specific elements in my PD arrays, I have those levels written down from the highest to the lowest in the order of their highest to lowest order. And a tiny little abbreviation as to what they are. And if there's a reference to time, I'm going to write the time that it formed. So when I'm watching price action go into the last hour trading, I was looking at this area right in here as a bearish fair value gap. And I was trying to set my phone to record it from my Telegram channel, and I couldn't get it to open up fast enough. So I had to take the trade, enter it, and then when the recording started, I had already executed, but I was still inside the 1 minute candlestick that was the entry. So you can watch that in the Telegram channel. I'm not monetized there. Okay. So all the things I share in Telegram, I could be putting it right here and making whatever more money that would equate to. I'm trying to show you things where it's just me sharing because I like sharing. Okay. If I want to make money in marketing, I can do that. Obviously, I've done it in the past. But I want to just make a point to show how we use this information now in the last hour trading. So we're going to take this information and zoom in. So we have this gap in here. And these are exactly how I drew them on my phone at the time. And I couldn't do a lot to do like a big screen on my computer because I was downstairs and I was away from constantly looking at the chart. So I could only run over to it, peek, run over to it and peek, run over to it and peek. And since I was using my phone, which is what I always will use for Telegram examples, I was managing from my laptop while I was 2 or 3 feet away from my wife. So I was juggling being a dad and being a husband and also trying to provide content. So inside this candlestick, I'm going short. I wanted to be inside this volume imbalance in this high. But because I drew the line on the phone, it should be anchored right there. So I'm going to leave it as it was on the Telegram channel so that we can see it. But the information here is all the things I had notes from that were sitting next to me that allowed me to see this as a setup. Aiming for the relative equal lows at 21,436.25. And then also you want to have this level here, 21,404.00. Those lows on the daily chart, you'll see them very clearly as what they are. But this level here is my next point of interest where I think sell side below that could cause things to get real interesting on the downside for NASDAQ.